There are a couple different negatives, I guess, heading into this year. One is that cycles that I look at tend to turn down right at the latter part of February and should be lower into about October, but it won't be a straight shot. So I'm actually expecting uh, potentially a 15 to 20% decline.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here for a special interview with Mark Newton, the head of technical strategy at Fundstrat, where he works there with his partner, Tom Lee. First off, Mark, thank you so much for joining us here. I know you're in the middle of Snowmageddon back there on the East Coast, and you have a lot going on here. So thank you for making the time to do this.
Yeah, my pleasure, Adam. Great to be back with you.
All right. And folks, you can tell I am on the road. I'm at the Vancouver Resource Investment Conference. And Mark, you can be pretty sure I'm going to ask you about gold and silver and commodities at some point in this conversation, because that's the topic du jour here at this conference normally. But given
Yeah.
the just amazing price action we see going on in the precious metals right now, I'd love to get your thoughts on kind of what you think the drivers of that may be, and how many, what kind of legs you think this rally still has going forward, because it's been
Yeah.
going on for a while. Real quickly, though, let's start more at the macro level. And Mark, you've been on this program before, and if memory serves, when I interviewed you, I want to say maybe in like late October or
Mhm.
early November, you were, I think you described yourself there still as sort of, cautiously bullish, given
Mhm.
what your models were telling you at the time. And I remember you saying that you had some concerns heading into 2026 that might cause you to be less bullish going forward. But of course, you said, look, I got to wait until we actually get there to see what
Mhm.
my models are telling me. Um,
Mhm.
where are you right now as we've now, what we're 3.5 weeks into the new year?
So I think we're setting up for much more of a choppy year than we've seen in years past. And we've had now 3 straight years of over 15% gains, over 20 for the first two, and now last year being up 17%. Heading into a midterm election year, normally that does tend to be the weakest of the 4 years that make up the presidential cycle. Um, when I'd spoken to you last, we were seeing a lot of breadth deterioration in many different sectors. That has to some extent been resolved in the last couple months since late November. We've seen a lot of sectors sort of spring to life, which is actually a positive. The one There are a couple different negatives, I guess, heading into this year. One is that cycles that I look at tend to turn down right at the latter part of February and should be lower into about October, but it won't be a straight shot. So I'm actually expecting uh, potentially a 15 to 20% decline, which starts in late February, early March, takes us down into May or June. We rally into the summer, and then we have a third quarter correction that largely marks the end of this consolidation. So I can't say that the secular longer term bull market is over. I do think it's sort of the pause that refreshes, so to speak, but I do sense that that is coming this year. And a few different reasons. One is because just the cycles are starting to suggest that that can happen. The second is that we're seeing sentiment finally start to get a little bit more optimistic on an immediate term basis. And that has less to do with really the short term geopolitical risk or sort of what's happening in the U.S. with a lot of the protests regarding immigration and this and that. It's more just about the attitudes towards the market have gotten a lot more optimistic, and that's something I was waiting to see. It really was never present last year. We went from rampant pessimism back in April to a little bit less bullish or less bearish throughout the year, but not really ever speculative and really optimistic. And we're starting to get to levels that are near that level. We're not there yet, but on a rally to 7,200, which I expect into late February, I think we'll get there. The other reason is that technology certainly has been sort of a shell of its former self. We're seeing, large cap technology, the Mag 7, many of these stocks have gone sideways for about 6 months. Noticeable slowdown in momentum, certainly sort of a changing of the guard. When you see, sectors like consumer staples are beating technology over the first few months, first few weeks of the year by about 300 basis points, it makes you pay attention that we're definitely seeing some sector rotation that it's important to pay attention to. And this is more than just mean reversion, I think, where the worst sectors of the prior year tend to outperform and vice versa. That can happen as you enter a new year, but I think that tech has gotten very overbought, and I think that this is going to be the year where we do see some weakness in technology. So the good news is that I don't think it's going to be an earnings-led decline. I think it's going to be largely just concentrated in large cap technology, maybe as interest rates start to push higher in the long end. But we have seen some great broadening out in many different sectors that have not worked in quite a while. And that's, I think, the bigger picture good news for long-term investors is that weakness this year should be buyable, but I sense it's going to be a lot trickier than people expect, and that's for bulls and bears alike.
Okay, great setup here. Let me ask you this. So you don't expect it to be a general earnings-led decline. And sorry, folks, if you can hear that noise outside. There's a like a seaplane landing runway right near where I'm staying here in the hotel. So you might hear that a little bit more while we're talking. Um, but so you don't expect this to be kind of a broad-based earnings-led decline. Does that mean that yes, the big tech you expect not to perform well, and because it's such a big part of the indices, it can pull down the S&P, it can pull down the Nasdaq. But if you are a maybe more nimble, active trader and you are, rotating into other sectors, you may actually be able to engineer a pretty good year for yourself, just as long as you're not in the parts of the market like tech that are getting dragged down.
I certainly sense that investors can outperform the benchmarks because if Nvidia and Apple account for 15% of the S&P and they're starting to go lower, this is going to be a great year. Not a great year. I think the portfolio managers will finally be able to probably show some outperformance over the benchmarks. In recent years, that's been very difficult as Nvidia has garnered more and more percentage of the S&P and Apple, and they've been pushing higher. And portfolio managers that don't own these stocks have had a real difficulty keeping up and showing outperformance. And this will be a year where I think if you own sectors like energy, materials, you can certainly even parts of industrials and transportation are doing very, very well. So I think, there's an interesting bifurcation where, historically we've seen great outperformance from the AI generators. And I think to some extent, this is going to push into more of the AI beneficiaries that probably do a little bit better this year, whereas the large cap tech stocks just need to pull back a little bit.
Mhm. When you say AI beneficiaries, do you mean other subsets of the AI market that are now stepping to the forefront? Or do you mean kind of general corporate America just finally benefiting from AI?
Yeah, it's interesting. I mean, we heard reports over in Davos that many governments are now starting to take an interest in AI across the globe, and I think many different areas of the market probably can start to benefit from that. And in the last couple of years, we've seen mostly those companies that have developed and started AI show the biggest gains, and now that's starting to show evidence of spreading. So um, I don't have the perfect words to describe it. I just think the market's getting a little bit more broad-based, and I think that in general is a good sign. But uh, a few warning signs on the horizon that I see that once we see evidence of technical trends starting to break down, and we haven't seen that yet, that would be a sign to probably adopt a little bit more of a defensive uh, stance, I think, between the traditionally bearish time, which is really May through October. And I think that probably starts earlier this year, probably in March or late
Okay.
February.
So I'm going to make an analogy here, and it might be a bad one, so please feel free to correct me. But um, made it in the past year where so imagine you have a basketball team made up of, five 90-pound weaklings and LeBron James, right? That team is still may able to win a lot of basketball games because of how dominant LeBron is. But it's not a very healthy bench, if you will, or a healthy team. Um, So we may be entering the period where maybe LeBron is stumbling a bit, maybe he's got an ankle injury or something, but we start replacing these weaklings with some better players. That's probably better off for the overall team's health, but the team may actually have a worse season this year as, LeBron is coming down and it's making the changes on the bench. Do you sort of see it like that, where in other words, like this broadening might be good long term for the market, but we may
Yes,
have an underperformance year because the star player is stumbling a little bit?
I think that's exactly right, Adam. I think when you look across the globe and you see many different stock indices at new all-time highs across Europe, certainly what's happening in Japan is extraordinary. Evidence of emerging markets starting to break out, and you see the EEM, the emerging markets ETF, has broken out to the largest level in over a decade. I think that's very constructive at a time when the dollar has started to turn down. Um, Meanwhile, we have the Dow Jones Transportation Average also that has recently broke out, along with the small cap IWM. Certainly not a time when normally, you would say, "Wow, it's time to really sell stocks." And I think it still is, from a short-term timing perspective. I think it is still quite premature by probably about a month. But I don't. I think you really have to watch carefully the degree to which technology plays comeback after earnings, which kick off this week. And I think if you have a sort of a slow, lackluster bounce between now and 7,200, and that would raise a few alarm bells, because I also suspect that more and more people would get on board the rally. So it's more about sentiment and cycles and just keeping a really close eye on breadth. And I think those are key. But for me, of course, as a longer term trend following technician, trends matter more than anything. And attempts to try to sell markets when they're in uptrends generally does not work out. People rarely can pick the top and the bottom as easily as you might expect. And so easier to pick bottoms during time of fear than tops during times of complacency. But we shall see what happens. I suspect that if some of the cycles that I look at are accurate, then March should be an interesting time for the market.
Okay. So first off, we're going to talk about the difficulty of picking tops when we talk about gold and silver right now, because they're just vertical at this point in time. So
Yeah.
vertical don't last forever, and so there's a big debate going on saying when is it time to start selling. But first off, let me both uh, thank you and curse you, if you will. So you brought up something I bring up a lot, which is just statistically, right? The markets had three near 20% years, as you said earlier, right? Back to back to back, which is rare for the markets. So to expect a fourth year of similar outperformance, just forget about fundamentals, technicals, et cetera. Just statistically, it's very, very rare, right? So I'm glad that you brought that up, which is to say, hey, look, we just need to expect that there's going to be some change at some point in time. Now, the reason why I'm cursing you is because, I get as I don't screen people for their point of view. I just bring on people who are intelligent and have a data-driven explanation for why they develop the market macro outlooks they have. That said, I would say the majority of people that I've interviewed over the past year have been, somewhat more pessimistic than optimistic. And so I get kind of painted with this brush that says, Adam, you only bring on bears, right? So I was hoping with you coming on, Mark, especially with your partner there at Fundstrat, okay, well, we're going to have a guy who's probably going to deliver somewhat of a bullish case. Now, Mark, I know that you, more than anything, just follow the technicals. So you're going to tell me what your technicals are saying. But yeah, people are going to say, all right, Adam, there's one more bear in the mix here. But you're just calling it as you see it.
So to be clear, Tom Lee and I have, of course, a different methodology and also a different time frame for how we look at things. I write a daily market report and do daily videos of the market, which covers all different asset classes. And I tend to be a little bit more tactical and shorter term than
Yeah.
Tom. So when he has an intermediate term bullish case on AI going on for years, I respect that for a lot of the right reasons. Even Tom has joined me in being a little bit more cautious for the first half of this year.
Mhm.
Um, and so, it's less about, it all depends on your time frame. And right now, look, the very short term is still bullish, and the intermediate term, meaning probably if you were to go out 5 years, I think we'll probably still be okay. But it's more about the time for between now and October, which I think is going to be very choppy and might give a little bit of a surprise to the downside, which some would argue is much needed. To your earlier point, I mean, there have been several times in history when we've had, multiple years of rising prices, and that doesn't mean you just rush in and sell because we've been up 3 years in a row. You have to always look for the warning signs, and for me, it's always about breadth deterioration, and or some leading sectors like tech that are starting to roll over cycles and really sentiment. And a few of those things are now in place this year, which makes me think it's going to be a more challenging year for investors, but also something where if you were to look to buy dips into the fall, I think it's going to be quite rewarding actually between late 2026 and 2028.
Okay, so if I took good notes, you said, hey, this is going to be a choppy year, meaning it's going to be more volatile than folks maybe have gotten accustomed to over the past couple of years. Um, and as you said, in the immediate term, like next month or so, you wouldn't be surprised to see an all-time high on the S&P,
Right.
right? So you're not predicting total calamity, and then you said there'll be some sort of correction. I don't know if I picked up sort of what magnitude you're talking about. I didn't get a sense that it's super dramatic. Then a rally, maybe mid-year, and then maybe a more pronounced slowing down at the end of the year. And I think you said something like, wouldn't surprise you to see the market down 15-20% by the time the year ends. Did I catch it all right?
I think that's right. If I could possibly share my screen, I will
Absolutely.
sort of share with you my, really what I expect from this year, and that I think we probably have the potential to get between 5,600 and 5,900 sometime in October from levels that are probably right around 7,200 on the upside. So ideally, this would work in sort of a three-wave type fashion where you initially have the strong sell-off into late spring, early summer, you rally into the summer, and then you pull back pretty sharply in Q3.
Okay. And
Uh,
sorry, I'm just looking closely here at the chart. And I know this is meant to be sort of instructive and not exact numbers, but you're looking at a correction of about 1,000 points of the S&P pre-summer, correct?
that's right. Yeah.
Okay. So,
Well,
so I mean, for
let's
some
say
people, it's not
I
catastrophic,
think
but that would sting.
I think I don't think that it probably will not happen before the summer, but I think it will certainly show signs of having started before the summer. I think the majority of the worst part of it might come between August and October, and I
Mhm.
think that's something to, and that's due to the cycles that I'm looking at for Apple and Nvidia, and both of those have a pretty rough late summer, early fall. But when you look at the actual cycle, this is one that I've used for years, and it had been pretty accurate in recent years, and it did show, the potential for, a rally into probably February, March, a dip, and then the period from late 2026 into 2028. That's one cycle. The other is just based on the 41-month cycle of that was created by Edward Dewey that measures, you know, it's one of the best longer term cycles for the stock market that I know. It's about 180 weeks or about 3.5 years in general. And it pinpointed the peaks in 2000, 2007, the bottoms in '09. It was very accurate throughout the mid 70s. And so it does show that this is a year of weakness for the market. These pink lines represent amplitude, not magnitude. It doesn't mean we
Yeah.
have to go all the way back down to the lows, but it is something that I think is important. And so, um, my sector wise, I've dropped my technology from an overweight down to a neutral. And my overweights for this year are industrials, energy, financials, and utilities.
Hmm.
And, meanwhile, I think a lot of the sectors are probably going to be pretty neutral. These are the concerns that I had heading into this year from last year. And some of these were partially reversed, that momentum and breadth have been waning since July. So those have improved. The broader market, number point two, has actually started to show good strength. And so when you say all-time highs, the Dow's already at all-time highs. The equated S&P is, and the Russell, and most of Europe and the transports, and there's a lot of really good things happening, but it's also being noticed by many people. And so, much of this is going to do with cycles and sentiment, I think, as to why, you know, the market starts to turn down.
Sure. So, Mark, thank you. Those charts are very helpful, and the chart you showed of uh, your current outlook for the different segments, very useful. I'm curious, given a year that you expect to be volatile and could end in a up to 20% correction, um, is your sort of approach okay, so ride out that year in these sectors that are likely to perform better. Um, I mean, I'm guessing yes, that's a big part of it, but also is there any de-risking in there, right? Like, hey, you might want to take, your portfolio down from 100% long to 80% long and then put it in these, better sectors.
Yeah, look, those are great questions. They really all have to do with one's own risk tolerance and time horizon for the market. And if you have a
Mhm.
time horizon that goes out till 2028, then you might decide to ride it out and just hedge using puts or VIX calls or maybe taking some technology off the table, emphasizing a lot more of the safety type sectors like consumer staples that are starting to show more strength.
Mhm.
Um, I do look at the market every day, and when I start to see trends break, then I will suggest that it's probably a good time to raise some cash to potentially put some money into treasuries. I think that between probably February and July, we do get some rally in the treasury market where we see yields start to pull back again. And so I think that there are some opportunities. And to your point on the metals, we can speak about that in a minute, but that has been, of course, just a phenomenal area. Commodities have started to come back with a vengeance, and I think that is very interesting during a time of the year when inflation largely has been, showing evidence of weakening. And
Right.
so it's interesting that commodities can rally if inflation is not really going anywhere, right? So the parts of commodities that are doing well, I tend to think that it is right to be very much diversified. The problem and you know error that investors made in recent years is really being too overweight technology, just
Mhm.
because of you have some QQQ or some SPY and you want to own Apple, and before long you look at your portfolio and it's about 80% technology. And most
Yeah.
people have been a little frustrated in recent months to say,
And sorry to interrupt, but you may own other, ETFs, funds that aren't marketed as tech funds that still have a ton of tech in them.
yeah, 100%. And I think that's the real key, is to know what you own. And so diversifying into areas that have some Coca-Cola or McDonald's, or, areas that have exposure to emerging markets, or have more a heavier exposure to commodities, or have exposure to emerging markets, I think makes a world of sense in this year, where the dollar to me looks like it's set to pull back to new lows under last year's lows, which likely happens between now and the summer. So if what I'm thinking is right, we're going to see a massive U.S. dollar devaluation, which it should be has already gotten underway in my view, and I've written about that in recent notes.
Okay, well then that's a great segue into the metals and commodity part of this discussion. So I don't remember if your slide there of the different sectors had commodities on it, but it sounds like you feel pretty bullish about commodities for this year.
Well, look, I basically sympathize with your point about most of the metals being in very late stages of their rallies, but you do have movement in silver for anybody that's a technician or takes the time to pull up long-term charts. I mean, this is has been one of the more bullish longer term base breakouts that we've seen in a long, long time. I mean, these peaks in silver last occurred near the Hunt brothers squeeze, and the movement just you know in the last 24 hours is being reminiscent. Silver's up 11% today, right? So
Yeah.
so we have not
And
only
that's
massive.
after what, almost quadrupling last year.
Yeah, well, that's the thing. You put this into perspective and you see that it made peaks back in 79, 80, and then peaks back, in 2011. And now that level has been exceeded. And technically, that can allow for a real acceleration. So I wrote this back in November, December, heading into the year, and my target for silver was 100, and now we're clearly above that. Um, the cycles are in the latter part of their uh, they're getting very stretched. And I think that, for me, I thought gold probably would get to, 5,000 and then pull back, and we're already above 5,000. So,
Yeah, so
my
we
thinking
just
is,
to interrupt, but we finally really cracked 5,000 last night, which was Sunday night in the futures market. It's now already 5,100. Like silver, it's just not looking back.
so I guess the issue that I have with the metals is twofold. And one is that, if you own physical silver, I mean, it's very difficult to unload it. The dealers are not taking it at current prices. There's some really interesting dynamics going on where it's just gotten really, really high. Sentiment is everybody around the world is now noticing that precious metals are moving, and they haven't noticed that for 2, 3 years. You and I talked about it in what, September, I think,
Mhm.
and or even prior to that, back in the spring, and that both of us were very bullish on the metals, and it was right to be long. And now it's a very poor risk reward in my view at current levels. But technically, I'm not able to sell it just yet. Um,
Because the
I
trend
think
hasn't started to show signs of breaking down.
it's not. No, of course not. It needs to before you really turn negative. But it's one of those things where the party's getting late and you don't want to be the last one at the punch bowl. And so, is
Right.
it right to stay at the party? Well, that depends on your risk reward. I do sense that we have another week or two. I am looking for a rally into early February and then a pretty good correction. Uh, However, you really need to do a lot of damage to think that anything that's moving parabolically, when you see your first sell off, that doesn't mean the peak's in and it's time to just
Right.
short. And it takes usually a number of different attempts at hitting highs before you roll over. So I do sense that we're probably a few weeks away from that. And February is probably the month when that happens and starts to sell off. I think that will provide opportunities on a 10, 15, 20% pullback for those that are traders. For those that are longer term investors, I just sense that you're very late to the game. And unfortunately, it's been a nice 3 year run, and now it's going parabolic. And usually that means it's a time to consider keeping your stops very tight. You never want to give back gains when something that's parabolic starts to turn, because sometimes it can really erase a lot of those profits. And just very important to keep a ruler out handy for those that are not technicians, and follow trends and certainly obey them when they start to be broken.
Yeah, so Mark, I'm at a conference right now where it's really interesting. It's kind of like, finally their year, right? I mean, I've been to this conference before. There's
Yeah.
at least two times the number of people here versus the last time I was here.
Yeah.
Uh, and it's funny because the old veterans, the guys that have been in this industry for 40, 50 years are saying, hey, like we've kind of seen this movie before. This is, in their opinion, it's gone into bubble territory. And by the way, these guys are, big precious metals champions, have been,
Yeah.
have a lot of exposure. But they're basically saying, look, when you get to the mania stage like this and the price action goes vertical, these almost never resolve by going sideways. They resolve in pretty brutal, price corrections.
Right.
And they're sort of saying like, look, if you're feeling elated by the gains that you've gotten in this metal, like congratulations, you kind of won the bet you made. But don't be an idiot and be naked along here as we're getting to the end blow off stage, and put yourself at risk of having your great gains vaporize if this follows this similar price action of other big mania spikes we've seen like this in the market. Now then you have a younger crew of guys here, who are like, you guys don't get it. It's different this time, right? Which of course the most dangerous words in investing. But it's a global monetary reset that's going on. The debt is now out of control. We've just passed the point where the U.S. debt service is greater than the defense budget, and it's a different world. And you'd be an idiot to jump off this. You know, out of this trade right now because it's got several legs ahead of it here. So where I'm going with this, feel free to comment on any of that. But where I'm going with this is you mentioned stops. Like for the average investor who maybe got in a year ago and is like, oh my God, my gold is, more than doubled and my silver has quadrupled here. um, maybe I should start protecting this in some shape or form. I don't want to exit the trade entirely. Do you have any particular preferred way to sort of play this, knowing this isn't personal finance, financial advice for any individual watching this? You know, is it more stops? Is it more just selling out and going to cash? Is it more using puts? You know, some options, right? What would you think?
Yeah, there's a lot to unpack there. I
Uh,
would simply say that it's always better to have a basic understanding of technical analysis and how charts can help you to manage risk versus listening to those who, are already dug in either bullish or bearish and might have their own ideas as to why they're working. And I can come up with a dozen reasons why, this should be a great year for precious metals. I just don't know that we have much gains probably after the first half of this year.
mhm,
I think interest rates are due to make a sort of a 6-year bottom. At least the treasuries are likely going to have a cycle that shows a peak in treasuries probably by the middle part of this year that is overdue, which means that rates very well could go higher over the next couple of years. Historically, that's not been great for precious metals, and you really want to watch as real yields start to creep up. And so I just worry that, I think that you never want to get too enthusiastic about your reasoning where you're avoiding watching actual price action itself. And right now, it's as people that are bullish see prices rise, they become more and more emboldened that, wow, this
mhm.
is the right call. And they completely have the blinders on as to why, when to get out. And if it's silver's up 20-30% in about a week, I mean, you sort of need to understand where you're going to exit and take profits, not just sit there. Um, the second point, and all this is always about respecting one's own methodology. And again, that's so much of this conversation is just different people have different time frames. And for gold, for example, even just since last August, we've been from what 3,200 to 5,000 very quickly. Any sort of minor pullback until it breaks the larger trend is probably still going to be okay to own. It's really when you start to break trends and even if you can't keep track of that, I would say watch when silver or gold start to make a new multi-week low. In other words, we're going up and up and up. Well, when does that stall and start to roll over? If you want to be short term, wait for it to make a new, say, 3-day low. And at a minimum, that will be very helpful. And I mean 3-day low on a closing basis. So right now we're going straight up. I never advocate people sell usually into strength. But when we start to roll over, that's the time when the buying has dried up and the sellers take over and things can get very volatile on the downside. So for very short-term traders, watch for a 3-day low. For intermediate term traders, use trend lines and or watch for a new 3-week low. And normally that can help you to, keep a lot more of your profits than trying to understand where we are in the cycle and saying, well, I'm just going to ignore the weakness because this is the new age. And yeah, I do sense that, the Fed obviously is in a challenging spot this year and is going to be under a lot of pressure from the administration. And there's no easy answer as to who is going to be the new chairman. And obviously, it probably is going to be somebody that's at least as dovish and probably is going to be more dovish than Powell. And so that's probably going to be good news. That means that rates probably will come down another 2 times this year. Normally, as rates come down, that's good for the metals. But the debt is a bigger issue. If tariffs were to be reversed by the Supreme Court, and we know that, you know, not taking any political stance at all, but certainly companies have felt, a certain sense of uncertainty, to say the least, when they don't know what their cash flows are going to be or where they're investing or what tariffs, what effect they could have. The tariffs have been a negative for most companies, but they've actually been quite a bit of a positive for when you look at the trade balance. And we've seen that have been cut in half down to 29 billion as of last month. That's really an impressive reversal and about
Mhm.
face, which means that the tariffs have been working quite well. So if this were going to be rolled back, how does that work in terms of compensating the countries that have paid us this money? And furthermore, we're not going to be addressing the spending anytime soon, and that's just going to lead to more and more, you know, payments that we're making where our interest payments are greater than we're spending on defense, and that's going to be eventually that's going to be a problem that is going to come to the forefront that it's going to be an issue. So my biggest thing is watch sentiment for the metals and try to find as many different sources of sentiment as you can. The CFTC positioning, or just talk to people around you. Everybody all of a sudden is starting to talk about metals. That's one sign that obviously is very unusual and it's come out of nowhere. Uh, but you want to see it actually in the price action. You want to see prices reverse, and that's the biggest thing. It doesn't matter what sentiment is. If prices continue to go up, then it's fine to be long. I just view it as a sort of a poor intermediate term risk reward given the parabolic state. And I personally am looking for exits. Last time we spoke, I said that silver and gold were one of my biggest longs for 2025. And then I told you in the last conference call, I think we're going to peak out in October. Well, we did peak out. I got rid of a lot of my gold and silver. We had a pretty sharp correction, but now it's right back up and even stronger. And I violated one of my own rules, is that the intermediate term trends weren't broken at all on the metals. It was a short, sharp 15, 20% correction. So it suited a lot of people that wanted to find a peak and short or get out. But yeah, for the longer term investor, you need to see evidence of these longer term trends being broken before you really address whether it's right to be in or out.
Okay. Let me ask you a more fundamental and not technical question here on precious metals. So one of the things that's been talked about a fair amount here at this conference is, and this is sort of a segue to your point about bonds, is you're starting to see more like Wall Street firms say, you know what, we had this 40 plus year bond bull market. We might be in a different regime going forward with bonds. And so you may want to look at the traditional 60-40 allocation and, look at that 40% that used to be in bonds and maybe take, some chunk of that and put that into gold instead of bonds. And number of people here saying that's the next big wave that's going to carry this gold bull market higher as that capital, because the gold market is pretty tiny compared to the bond market, so it wouldn't take too many percentage points of bond capital to flow in here to still give a lot more octane to what's going on here. Just given your proximity to what Wall Street is doing, is that a potential macro trend factor that you're paying any attention to?
If one is not invested in gold already on an intermediate term basis, I would not suggest that that's the right move to make, at least for me. I don't think that it's an attractive risk reward for the year for metals. But I think that right now prices are going up. It's fashionable short term, but uh, treasuries are going to be a better risk reward, I think, for the next 6 months and thereafter. If gold, let's say let's say yields get down to 385 on the 10-year, and all of a sudden, precious metals have corrected 20 to 25%. Well, maybe I would consider it then. I certainly do think that this year, more than ever, is a good year for diversification, but I can't simply say that gold is probably the better area. In general, commodities would make more sense as a bucket because I think crude is likely going to be ending its 3-year bear market sometime in the next month. And I do sense that prices go pretty sharply lower from here. But I also think that energy is going to outperform this year. I sense that crude is going to have a pretty good lift between probably March and July.
All right, I'm glad you mentioned that. I've been increasingly talking about the prospects of the oil and gas industry with a lot of the experts on this channel. In fact, the video right before this one, Mark, was with Rick Rule. I don't know if you know who he is, but he's a very well-known natural resources investor, and basically said, look, I think the oil and gas sector is as attractive as I've seen it in my career. Now, he's not talking about a quarterly outlook. He's talking about at some point over the next 1 to 3 years, he
Yeah,
thinks that thing might swing back into boom because it's been in bust for a good while, and
yeah.
you can get in at attractive prices now and get paid to wait because a lot of these companies pay pretty generous dividends. So it sounds like you're seeing corroborative uh, data, using your very technical driven methodology here.
I do. Some of the cycles that I look at for crude oil do tend to bottom really in the next couple months and start to turn higher. I think that this recent little bounce is more Iran related and probably a little bit of a head fake. I do sense that crude probably gets to 65 but then it should have a pretty big pullback, which might start in maybe mid-February and start to go lower, and that should be really the final washout for crude oil, in my view. And then at that thereafter, I would agree with that. I think that anything with regards to Venezuela, we need to get prices materially higher to make that attractive at all to even consider if the U.S. were to attempt to go in and extract or get Venezuela up to, let's say, 2 or 3 million barrels a day again, from under a million now, right? So I think that's is that correct? Or I'm thinking of yeah. In general, I think their total output has just been reduced substantially, and it would be so costly. I think the CEO of Exxon said it right, that it's really unattractive at this point. So for AI also, we know that there's going to be a need for fossil fuels. And so I think that Saudi Arabia and the US, have probably cut a deal a few months ago to keep prices low, but I don't sense that's going to last forever. And I
Forever.
sense that probably in the next quarter that we probably start to bottom and start to move up.
Well, what I always like, given my position of being able to talk to lots of different people, is I like when I hear different analysts using different methodologies come to similar conclusions, right? That's a pattern that when I see it usually says there's probably something there, right? Because people have
Yep.
different lenses, they're using different approaches, yet their you know process brings them to the same point of view. Now, Rick is very much, he's very much he's not a technical guy like you
Yep.
are. He's much more macro, but he's very close to the production side of things. I mean, he
Yep.
knows all the people that own the wells or own the mines or whatever. And, a big part of his outlook is one that global demand is going to keep growing for a whole bunch of reasons, but
Yep.
in the commodity industry, in oil in particular, the cure for low prices is low prices, right? Prices get low enough for long enough, people just stop exploring and developing because it's not profitable to do so, and then supply gets tight as a result of that, and that shoots prices up, and then the boom cycle starts.
Yeah, and so I just look at it more about cycles and trends, and short-term trends certainly have turned a little bit more bullish for crude, but I sense that near term we might push into the mid 60s, and then we're going to have a pretty big sell-off for reasons that I probably don't understand the fundamental reasons for, but I think that will provide a pretty good buying opportunity for crude. So
Okay, well, it looks like crude is broken out from at least the trend line you have drawn here. If it gets up to the mid 60s and then has a correction, would you expect it to go back down to that trend line, or is the trend line now changing because of the break?
yeah, no, I think it probably does. I mean, it's funny because I look at a combination of like Elliott wave and cycles, and most of the stuff for crude does show just over the last couple decades that we're due to start a pretty big move up, and this lasts into the summer, but we'll see if that lasts or not. Energy itself, many different parts of energy have been working very well, and OIH, XLE, of course, the exploration and production have been a big laggard. I think there's probably a little bit of a bounce here, but then that's going to be a little bit weaker. So it'll be, yeah, it's an interesting sector for sure, but different parts of commodities are starting to perk up, and that's definitely interesting to me.
All right. Well, Mark, if your schedule allows, love to have you back on in Q2 and, call an audible for us on what you see going on. But if it turns out that a lot of the things you've talked about here kind of come to pass, it could be an interesting time for, the investor, the type that watches this channel to, maybe start to really take some action on some of these things. Because it sounds like if we get that drawdown in oil after hitting the mid 60s, that could be a good time to really get in before the pop you expect is going to happen. Um, it might be a good time, I guess now you're saying maybe to buy some bonds and by midsummer might be time to get out of them if things are bottoming them. But
Yeah,
just
the biggest thing that I see is the dollar really having started to accelerate dramatically to the downside.
to the
And
downside.
so this has already broken down to the lowest level almost since last fall. And so that one can get long the euro and get long pound sterling. The yen is going to take some time. That also eventually should rally a little bit. But what's happening with Takaichi, I sense the dollar yen is going to be quite weak between probably the spring and the end of the year. So any sort of pullback you see in dollar yen, if we get down to 147, 150, should be a chance to really get short the yen for a chance for that to probably get to 175 or even 200. So I sense that, Japan has been through just a relentless wave of, deflation for so long. They're willing to tolerate inflation, and to the extent that, the JGBs have been, you know, showing such volatility that Scott Bessent, placed a call over to Japan. I think that they're going to try to. We'll see what happens, but I sense that we're going to start to see rate hikes, and at some point we're going to see a. I think this year is still going to be very weak for the yen, so that's interesting. It probably means their stock market, it might correct during the same time as ours does, but it should be a great time to own Japan for the years to come at all-time highs.
Okay. All right. Well, look, I know you got to get off in just a minute
Yep.
here. So real quick, you showed some of the cycles that you look at. I'm just curious, I interviewed Michael Howe recently. Not sure if you're familiar with him, but he's liquidity is his big thing. He's a former Salomon Brothers guy. He's
Yep.
been, following these liquidity models for decades and decades. And from the years I've been interviewing him, his calls have been pretty good, and they're largely based on what's happening with liquidity flow. So, for example, he was, I think, the first guy I know to really go put his neck out and go long in October of 2022. And it was largely because, his multi-year global liquidity cycle had bottomed and was starting up again. And, with a lot of people I interview here, sometimes I do just say, look, is it really at the end of the day just all about liquidity? Because when the tide is rising, all boats kind of go up with it. So his model, he thinks the current multi-year cycle peaked out in Q4. So
Oh,
we just started to peak, and it's, we probably have a multi-year down cycle against it. And the cycles are the duration is variable because it depends on the speed of the decline. Um, but he's basically kind of like you saying, hey, we're going to start having more headwinds this year. It's going to be a more volatile
yeah.
year because of liquidity. Do you look at liquidity at all in do you take that into account at all in your soup of data that you look at?
Yeah, no, I really do. There's so much information to look at. It's not part of my personal toolbox. If I can just look at sector rotation and trends and sentiment and seasonality and cycles, they tend to provide a lot of the shorter term, avenues that really can help investors stay on the right side of trends. I mean, liquidity is a longer term type thing. In my view, it would probably take a longer time to make heads or tails as to if you take a stance based on liquidity, it might not materialize right away, but it
Right.
certainly for an intermediate term would be important. I would think that, cutting back on QT, could produce the opposite in the short run, but we'll see. And if they ratchet rates down another couple of times, I think that would be helpful. But we still have an affordability problem, of course, in the U.S. and
Mhm.
housing where it is, and mortgage rates they've come down to 6%, but they're still roughly double what they were a couple of years ago. So yeah, we'll see how that all shakes out.
All right. Well, Mark, I can't thank you enough, especially for squeezing this in, everything that's going on in your busy
Of
schedule.
course, yeah, my pleasure. We got hit pretty hard with about 15 inches of snow out east, but everything's going to be just fine. So
All right.
bottom line is stay the course. Depending on your risk tolerance, stay the course. But I expect eventually the S&P for the year might get to 7,300, and 7,200 might be possible over the next month. But I'm after that, I think it's really going to be a choppy time for spring and really Q3, and you want to buy dips into that in October.
Okay. So, again, I'd love to have you on quarterly at least, just to kind of provide
Great.
a chance to provide audible calls and all that in case other things are changing. For folks that would really have really appreciated this and would like to follow you and your work between the next time you come on this channel, Mark, where should they go?
So I would either suggest going to fundstrat.com, Fundstrat, or FS Insight. We have a product for both retail and also institutions. Myself, you can follow me on X on Mark Newton CMT, and happy to provide your viewers with maybe a link that they can click on or a QR code that might be that can bring you to that. I'll provide you with that after the interview.
Great. So, Mark, as usual, when I edit this, I'll put up the links to those URLs into your X handle.
Yeah.
I'll also put the links in the description below the video, folks, and also down there, Mark, if you send me that that code or that link, special link itself, we'll put it there too, so folks can get to all those places with just one click. Mark, it's always such a pleasure. Folks, please do me a favor. Please let Mark know how much you appreciate him coming on by hitting the like button and then clicking the subscribe button below, as well as that little bell
Yep.
icon right next to it. And if you want to get some help in taking some action in your portfolio based on anything that Mark and I discussed here, if you don't already have a good financial advisor advising you on that, feel free to talk to one of the ones that Thoughtful Money endorses for free. To do that, just go to thoughtfulmoney.com, fill out the short form there. Mark, really hope you get home okay today. Strap on those snowshoes and get some hot chocolate.
Thank you, Adam. Happy New Year to everybody, and look forward to talking to you again soon. Take care.
All right, thanks so much. And everybody else, thanks so much for watching.
I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. We're very close to breaking out of that, and I think we're about to. I think we'll see it in September, and have another nice run, probably to 4,000 in the last 4 months of the year. Silver, I have a 75 target that I've had for a long time. I think gold can get to 20,000 by the early 2030s. And I say early 2030s. That does not mean 2030. It means could be 2032 or 3. I don't know.
Yeah.
But 20,000 for gold and 500 for silver.
Gold recently hit a record high of around $3,526 per ounce, buoyed by a weaker US dollar, inflation fears, and declining confidence in treasuries. Analysts from Goldman Sachs and Morgan expect gold to reach $4,000 by mid-2026. However, silver is the standout performer of 2025, up around 40 to 42% year-to-date. Optimism is growing that it may finally break a multi-year underperformance trend relative to gold. For silver, the near-term target is $75. While the long-term targets of $20,000 for gold and $500 for silver remain highly speculative, current trends and expert forecasts suggest gold may approach $4,000 in the near future, and silver could begin to make significant upward moves. The speaker, David Hunter, a famous personality in precious metals, believes Wall Street has been too skeptical of this rally, while retail investors have fared better. Strong corporate earnings, driven partly by AI, and an underlying weak economy point to lower interest rates ahead. He expects the 10-year yield could fall to 3% by year-end and eventually to 0% as his global recession or global bust unfolds. Contrary to the mainstream view, he sees both short and long-term rates moving down, supporting bonds and even corporate credit in the near term. Hunter views this as the final stage of a 43-year secular bull market that began in 1982. With the Dow then at 780 and potentially reaching 60,000 soon. Falling rates, strong earnings, and a weaker dollar could fuel a parabolic move higher as institutional investors finally capitulate and turn fully bullish. In Hunter's view, this capitulation will provide the momentum for a steep final run in the equities. Let's dive into the video for more insights. If you enjoy the content, don't forget to give us a thumbs up and subscribe to our channel for the latest updates.
I think what we're going to see, and it's starting to happen, as I've said for a long time, from basically 2022 up, from October 2022 bottom down at 3,500 on the S&P, and I don't remember where the Dow was, but from that point forward up until very recently, and even now, most of Wall Street was skeptical. Retail did better in April. They didn't fall for the head fake, and they stayed bullish and they bought generally. So a lot of retail got scared, but generally the retail did better. Institutions got bearish, and they've been skeptical of this market all the way up. They keep looking at valuations and thinking valuations are at peak levels and they can't go much higher, and et cetera. What we're seeing is obviously because of AI, but also other things, the companies have done a great job in an environment that wasn't that easy to keep pushing the earnings higher. And, I saw that. That was part of my thesis. I also think people are way too bearish on the bond market, on interest rates. And I think, in fact, I'm very bullish on bonds and think rates are going to go a lot lower. And that's different from, I think, the street. But ultimately, I do think the US's rates are headed lower, both on the short end and the long end. I am very much and have been consistently saying, though today's GDP, for example, came out with a revision upward, 3.3% on GDP for the second quarter, I still believe under the surface, we have an economy that's not doing that great. And we have an economy that's heading for recession. So that has kept me bullish on bonds. I'm not so worried about exactly when it turns or how much it turns initially or whatever. I do think you're going to see the 10-year go to 3%, maybe by the end of this year. It doesn't have to be by the end of this year, but maybe. And ultimately, next year is going to be a rough economy, in my opinion. I call it a global bust. And in that, I think you can see the 10-year all the way down to zero. So I'm contrary to say the least. But I am not in the camp. I know there are a lot of people that look at last fall and say, oh, the Fed can lower rates, can cut rates, but the long end's going to go up. And I know that's a big story around Wall Street. I don't believe that at all. I think you've seen, basically, I'm more focused on the 10-year because that's what loans get priced off of, mortgages get priced off of. But even the 30-year will ultimately fall. It may be stickier to come down initially, but ultimately, I think all rates across the curve are going to come down. And even the corporate bond market for at least a little while longer is going to do okay. That we're in the end game of a 43-year secular bull market. At one time, I thought it was going to be a 42-year, and it stretched out. But it started in August of 1982. And the Dow at that time was, I can remember because I was running money then, and I turned bullish in August of 1982 in a new place where I basically had a great run. And they fought me. They were not equity guys. They thought we were crazy to do what we did, but I had top percentile numbers for 5 years running. The Dow back then was 780, wow. 780. And I'm calling 60,000 for this year. And frankly, I get beat up, as you know, all the time about moving my time targets. I don't have a time target per se. I do. I'm not saying it can happen anytime, but whether it happens in October or November, December or January, I don't care. It's coming soon. And people say, oh, you've already pushed it out again. No, I haven't. I haven't changed anything. I still think it could happen, by October or November. But anyway, it's rates coming down and earnings going up, still holding firm. And very big part of this, and the dollar selling off, and a very big part of this is Wall Street moving from constantly looking for a top with one foot out the door to being all in. They're getting closer to capitulating here and saying, yeah, I got to get more bullish because this thing has legs. And that's going to be the fuel for what I think will be a very steep run. But in answer to your question of how you could go that far, that fast, it's a parabolic that I think comes at the end of such a long cycle.
David Hunter recalls his success in 1982 and draws a parallel to today, noting that when the Fed eases, bonds, equities, and metals typically all rise. Hunter expects a similar setup in the coming months but warns this cycle is unusual since it didn't start from a bear market trough. While many have fought the rally, Hunter believes the eventual top will come when everyone is fully bullish, at which point he'll turn contrarian, and quadrillions in derivatives turn a normal downturn into a severe global bust. On commodities, Hunter has been bearish on oil since 2022 and sees it possibly falling to $30 during the bust but then soaring to $500 by the early 2030s. Hunter argues massive money printing, $20 trillion in the US and up to $50 trillion globally, will drive huge demand for commodities to build new infrastructure, while supply growth remains constrained for years. This mismatch, Hunter says, ensures explosive price increases once demand outstrips limited supply.
I guess I cut my teeth in this. Like I said, my favorite time to remember was 1982 because I hit it right on a dime and had really top 1 percentile pension fund manager performance for 5 years running in a shop that I had to drag along kicking and screaming. So I remember that very well. It's also reminiscent of what you get at when you have the start of a Fed easing cycle, right? So when the Fed starts printing, what moves? Rates move down, so bond moves up, equities move up, and metals move up. And so that's what it's going to feel like, I think, in the next 3 or 4 months. The thing is, we're not starting from a trough.
Sure.
We didn't go through a bear market. So that's what's unusual, and I think that's where people are going to probably get it wrong. Is they fought this all the way up. I keep saying that at the top, what you'll see is everybody will be all in and tell you this thing has years to run, at least a couple of years to run, and I'll be at that point contrary and saying no, this is the top, or close to the top. And I think we will actually see CPI negative, PPI negative, even PCE negative, and it comes. My reasoning is pretty simple. It's number one, we're highly leveraged. The reason I call for a global bust is because we're so far beyond even 2008-9 in terms of leverage on the system, both debt, as I keep quoting, 330 trillion in global debt, and I realize a lot of it's sovereign, but 330 trillion in global debt, and quadrillions in notional value of derivatives. Never been here before, never. And derivatives are leverage on markets, debt is leverage on the system. Never been here before. I mean, this is so far beyond anything we've charted in our past. That'll turn a normal downturn into something far worse, I think. And so, and obviously a financial crisis if leverage starts unwinding. So that's how I get to a global bust. I de-bear on oil since 2022, and correctly so. I turned bearish on oil before we had the spike up during the Russian invasion of Ukraine, but I stayed with it at 130 and said we're going back to 85. And then once we broke 100, I said we're going to 60. So I've been pretty bearish on oil. I think we see probably 30 in the bust. And then from there, and it could certainly go lower given what happened last cycle, if you remember when it went to negative.
Who knew?
But I'll say 30. And from there, I think you could see $500 oil by the early 2030s.
Wow.
So again, as I say, it's a commodity cycle. Copper could be 20 or more. It could fall to $1 or $2 in the bust, but go from there to 20. Natural gas might be $50. I mean, I don't know where these things are going to go. What we're going to have is massive demand for commodities because they're going to be needed for building new plants and equipment and all that. Because of that 20 trillion print and probably 50 trillion worldwide, it's gonna goose demand, and we've rationalized down supply, the mining and all that, and search for oil, et cetera. We've rationalized that all down in a period when they were trying to discourage all of that. So if we get that through the roof, like I said, the demand because of the money print can happen within 1, 2, 3 years, whereas the having to build new supply can take 10 or 20 years. So you're going to have a case where you have supply far exceeding demand, and the only thing that can give is price.
David Hunter envisions an extraordinary but volatile path ahead. First, a deflationary global bust, then an unprecedented boom fueled by massive money printing, collapsing interest rates, and surging demand for commodities. While his bold forecasts for gold, silver, equities, and energy markets remain controversial, they highlight the risks of extreme leverage and the potential for historic shifts in global markets. Do you think Hunter's prediction of a global bust, followed by explosive commodity inflation, is realistic or overly extreme? If gold and silver do reach his long-term targets, how might this reshape global financial markets and currencies? We'd love to hear your thoughts in the comments. If you found this video helpful, give it a thumbs up and subscribe for more updates. Thanks for joining us on this journey.
Russia, China, and now India. Um, you know, uh, Global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system.
The trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by. I don't. $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond.
Central banks, especially in India, Russia, China, and other global South nations, are boosting gold reserves while cutting U.S. treasuries, marking the first time since 1996 that gold has surpassed treasuries. India alone has reduced its T-bill holdings to $227 billion, while raising gold reserves to about 880 tons. Meanwhile, Eric Jung predicts that with gold hitting record highs above $3,500 to $3,600 per ounce, forecasts project $3,700 to $4,000 by mid-2026 and potentially $5,000 plus if Fed independence is challenged and a wider shift from treasuries accelerates. So the U.S. can revalue its treasury gold reserves at much greater market levels. Eric Jung is a financial commentator and analyst who frequently discusses gold, silver, and macroeconomic trends. He highlights that gold consolidated for months before breaking above $3,500, while silver pushed past $40. Many dismiss the idea that Trump's tariff threats explain this move, since that narrative has been recycled for months. What really drove the breakout was the recent BRICS meeting and India's shift, reducing U.S. Treasury holdings while increasing physical gold and silver. Combined with America's ballooning $37 trillion debt and talk of confiscating frozen Russian assets, these pressures pushed India further toward hard assets and away from treasuries. This reflects a much larger global trend. Countries like Russia, China, and now India are abandoning U.S. treasuries and adopting physical gold as a reserve asset, signaling a fundamental change in the financial order. Unlike treasuries, which can be frozen or seized by Washington, physical gold held at home cannot be cancelled by a foreign government. Eric believes as a result, sovereign demand for gold is accelerating. For additional information, view the video. Please subscribe and like the material if you enjoy it to receive the latest updates.
Gold, I think, consolidated for around 5 to 6 months, and it broke out of 3,500, so $3,500 US dollars per troy ounce, and silver went beyond $40. I think that was the top it made several months ago. So it's now above $40 US dollars per troy ounce. And I know the mainstream narrative of all this is that the tariffs, the Donald Trump tariffs, potential tariffs on gold and silver is not clarified, but I don't buy that because they've been using that narrative for over 6 months. How stupid do they think the authorized participants are? The bankers are, right? This is ridiculous. I think what really happened is BRICS happened, like that BRICS meeting that just happened, and what happened in India. I don't know if you know, Danny, but the Indian central bank is now reducing their U.S. Treasury bonds and T-bills holdings and increasing gold, physical gold, and guess what? Also silver, physical silver holdings. Okay, that's why I think, in my opinion, that's why gold and silver broke out of their trading ranges. Donald Trump, but it's funny that it just seems that nothing that India does pleases Donald Trump. And Donald Trump came back with a 100% or more tariff on India. So I don't know. I think it's as simple as that. It's just like somebody is trying to be nice to Donald Trump, and Donald Trump instead slapped additional tariffs on that country, and therefore that country is pushed over the edge. And now, they are reducing officially their U.S. Treasury bond holdings. But I think the underlying reason, Danny, is we have said this before. Two things. Number one, look at the U.S. national debt, $37 trillion and counting. $1 trillion of additional debt every 3 to 4 months. Okay, so this ain't gonna stop. Number two, recently the EU is supposedly potentially going to be pushing the button to confiscate the frozen Russian assets. Okay, that they froze, when Russia started that special military operation in Ukraine. So I think combining all these different, factors just really gave India the extra push to push that button to let go of the U.S. Treasury bonds and T-bills and dive in officially into gold and silver. Then recently, gold just shot up and exceeded U.S. Treasuries. So, I know a lot of people make fun of this, but what that tells me is that, led by the global South, Russia, China, and now India, global South countries and non-US, I would say super allied countries, okay, are now turning to physical gold as a viable international reserve asset in place of US Treasury bonds. So we are seeing a monumental change, okay, to the system. Because going forward, I don't see there's any, significant steps of this trend in reversing. Simply because in a multipolar world, physical gold is not controlled by any individual country. Nobody can just push a button and cancel the physical gold that, let's say, India, China, and Russia hold at their, domestic vaults. Okay? But, let's say if you hold a lot of US treasuries and you piss off Uncle Sam, somebody like, I guess Bessons or Jerome Powell, whoever, can go back to the office, push a button, and buy. Your stuff is frozen, or worse yet, it's going to be confiscated or deleted or whatever, right? So I think, like I said, the flight to physical gold at a sovereign level is not going to stop. It's simply going to accelerate. And physical gold, like Francis was saying, is just at its beginning phase of being remonetized. And it's going to accelerate going forward.
Francis Hunt, known as the market sniper, along with Eric Jung, points out that central banks remain steady net buyers of gold, with India notably reducing U.S. Treasury exposure while increasing its gold reserves over the past year. Analysts warn that even modest reallocations from treasuries into gold, potentially in the hundreds of billions, could drive prices sharply higher, given tight liquidity and the outsized impact of institutional flows. Forecasts suggest gold could reach $3,700 by end 2025, around $4,000 by mid-2026 in base cases, and near $5,000 in stress scenarios, expanding its market cap from roughly $24 trillion to over $31 trillion. This shift is driven by geopolitical tensions, rising U.S. debt, and concerns over dollar-based assets being frozen or seized, making gold the preferred non-sovereign reserve asset as nations diversify away from treasuries. Let's just get back to the interview.
What percentage of that is losses in treasuries as well and gains in gold, which further eggs the point rather than saying that there's no one selling, but people don't like to accumulate an asset that is losing value, and they double down and accumulate assets that for the extended future they see as accumulating value. No one gets fired for buying gold or for hiring McKinsey, they used to say. I don't think central bankers, and it also puts something else. I'll throw two other thoughts in on that chart, which I love, and I'm glad you shared it. I saw it as well. There's no chart for it, but I can tell you those nations that are accumulating and also seeing appreciation in their gold whilst not adding to their treasuries and watching devaluation, they're also not choosing Bitcoin. They're choosing gold. They're choosing gold predominantly here. And that tells me there's a very Americanized probable stigma in terms of the potential creation, because there's been no embracement by institutional central banks in the Deep South or the Grand South or the Global South and the BRICS nations in terms of Bitcoin on a meaningful basis. They accumulate it where they have a criminal who's trading in stolen cars or something, right, fine, and they hold it. But there's not a net accumulation on that side as well. So I think when you look at the big money that knows, the big money has spoken and the winner is gold. And the appreciation will be far more safe in a less volatile way, and you won't have to watch an 80% cycle deval or 75% one if you miss the perfect selling point either. And people need to remember those key aspects about Bitcoin and gold, and why I think gold is the winner. It's the safe hands for everyone. Yeah, in terms of the market cap as well, again, because don't forget $1,500 extra on the gold ounces. That's actually in percentage terms from 3.5. It's almost like another 50%. It's probably around 35 to 40%. So you would go from 24 trillion plus another third. You'd add another 8 trillion on that, and you'd be at 31 trillion. So I don't, $5,000 would mean it's a 31 trillion market, which I certainly see happening and going beyond 50 and beyond. Eventually, my feeling is that whatever the debt market was at its high point, the amount of money we felt existed at its biggest bubble of the debt market, we end up seeing that deflate. And by however much that deflates, gold goes up, because there's really only one trade for me. What do? You don't buy real estate that's already leveraged with debt at ridiculously high prices. You don't chase a hyper overvalued record PE stock market. Some people will, and there will be elements. But when this is fully played out, the natural approximate geometry is however big the trillion market cap of that debt market has to go down to be fully reset. I don't know if that's zero. Gold has to go up by.
The accelerating move by central banks, especially in India, Russia, China, and other global South nations, away from U.S. treasuries and into physical gold signals a historic reshaping of the global reserve system. With gold breaking record highs and forecasts pointing toward $4,000 to $5,000 in the coming years, the metal is regaining its role as a core anchor of financial security, driven by sovereign demand, geopolitical uncertainty, and distrust of dollar-based assets. Could a mass revaluation of U.S. Treasury gold reserves at higher market prices fundamentally reset the global financial system? How might continued BRICS diversification into gold and silver impact the long-term dominance of the U.S. dollar? We would love to hear your opinions, so please leave a comment below. Please remember to subscribe for more material, and give this video a thumbs up if you found it helpful. We appreciate you joining us on this adventure.
Silver is going to fail to deliver. In my eyes, that's within the next few delivery periods. So I think before year end, you're going to see the silver market break. That will immediately spill over to gold. Clearly, China has way, way more gold than they say they have. I think probably Russia too. And just go back to the old saying, he who has the gold makes the rules. And that's what they're preparing for. They're preparing for the dollar/bonds, treasury bonds to implode.
I mean, so much is going on under the radar here. And that's probably because a lot of, when you think about the gold that's flowing into China, gold and silver flowing into China, it goes through 42 customs districts, which have 680 individual customs offices. I mean, there's so much fiddle room here. It's unbelievable.
Given that failure to deliver is expected to occur during the next few delivery cycles, probably before year-end, the silver market appears to be on the verge of collapsing. The shock would swiftly leak into gold if that were to occur. As the USD and US Treasury bonds teeter on the verge of collapse, China and Russia are likely holding significantly more gold behind the scenes than they acknowledge. While central banks currently hold almost 36,000 tons of gold, making it the second largest reserve asset after the dollar, and, in some ways, surpassing the euro, China is relaxing gold trade regulations to facilitate physical movements. Gold has reached fresh highs due to geopolitical threats, record central bank purchases, and waning dollar outlooks, and a WGC survey indicates that the majority of central banks want to boost gold holdings while cutting dollar exposure. Bill Holter, a well-known precious metals analyst and commentator, with Andrew Maguire, a veteran precious metals trader, highlights that gold and silver are seen as the ultimate hedge because, unlike paper assets, they can't go bankrupt. Recent reports show gold and silver prices are rising due to heightened geopolitical tensions, weak dollar expectations, and inflation concerns. Silver has lagged gold somewhat, but many commentators believe the gap, gold-silver ratio, indicates silver is undervalued. Silver, in particular, looks to be breaking out as China tightens its grip on the physical market, leveraging that position to influence paper trading. For years, nations like Russia and China quietly accumulated metals to avoid direct confrontation, wary of U.S. military power that historically enforced dollar dominance, examples being Saddam Hussein and Gaddafi, both eliminated after pushing for gold-backed alternatives. Dalio warned the U.S. economy is showing signs of a financial heart attack, driven by rising debt costs, citing its history of rising in crises and protecting against currency devaluation. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Gold and silver, and the reason being gold nor silver can bankrupt. They are money themselves. They cannot bankrupt in a world that is bankrupting.
Absolutely. And I think if we can revert back to silver for a minute, because what we're seeing here is a huge, long-awaited breakout. I mean, obviously, we all know that China has been in the driver's seat for a long time, and they've been playing the arbitrage trade and, being in control of the physical side of the market. They could arbitrage the paper side, but essentially, what we're hearing is, hey, gloves are off now, and especially after Trump's most recent BRICS attack on the BRICS, like clearly putting the BRICS in the crosshairs with tariffs, and then most recently some very odd statements that he made after the SCO meeting.
Your comment, the gloves are off. I think that's up until this point. I mean, it would be extremely easy to break the Western financial system with $5 or $10 billion. I mean, if you went into COMEX and LBMA and said, "Here's $10 billion, I want metal," it'd be over. There's no way to deliver that kind of metal short term. So it would break the markets. In the past, I want to say that Russia, China, the rest of the world were being polite because they didn't want bombs raining down on them. One of the big things, the reason the dollar has been the reserve currency for so long is the U.S. military. Basically, we forced the world with threat of the U.S. military. If you don't use dollars, I mean, look at Saddam Hussein. Look at Gaddafi. They both talked about, 15, 20 years ago about doing a gold-backed currency. And what happened? They were killed. Mm. In the past, countries have seen, those two examples, Gaddafi and Saddam Hussein, they saw those examples and said, well, yeah, we'll just buy it quietly. And now that the war of words is on, it would not surprise me to see either a country or countries together step up. And the Achilles heel to the Western system is the fractional reserve nature of the entire system. But the way to expose that is just create a failure to deliver in either silver or gold, and it'll be both within 24 hours. If either goes, the other's going to go within virtually immediately. So they're at the point now, like you said, the gloves are off, and money is just flowing into whether it be the physical metal itself or even the leveraged contracts in the West. You're seeing foreign nations buy those.
And I think most recently, and I know we're recording this on the 3rd of September, so it's not really a time-sensitive thing we're talking about here, but essentially what just happened, and I don't think this is clearly not going to change, is that it's quite clear from Trump's comments that the SCO meeting between these major hubs that you're talking about, and military powers as well, really ruffled the White House's feathers here. And they're not handling it very well, because basically, I guess really, I mean, maybe I'm naive to think, wouldn't it be better to have a multipolar world where you take all the barriers down? But I guess US dollar hegemony is the problem here, is it?
Well, that's the problem that the rest of the world sees. The rest of the world wants to get out from under Uncle Sam's boot, if you will, by using dollars. They don't want to use dollars, and they prefer not to be in the SWIFT system. I mean, ask Vladimir Putin. The U.S., the West, stole 300 billion plus of U.S. treasuries going back to, 2023, October 2023.
According to Bill Holter, cryptocurrency was created as a diversion from gold and silver, which are the real alternatives to the dollar. Since silver was designated a key mineral in the United States, its significance has increased, potentially limiting world supplies and retaining domestic production. Deficits are growing as Mexico's output declines and industrial demand for electronics, EVs, and solar rises. Silver may also be withheld by nations until prices significantly increase. By 2026, analysts predict prices to reach between $40 and $52.50 per oz. However, since no fiat could purchase gold and silver in the event of a currency collapse, they might become invaluable. Let's shift our attention towards the interview.
But I believe that the crypto market was created as a pressure relief valve from gold and silver, because they are viewed as an alternative, dollar/currency alternative.
But silver's got my attention at the moment, and because you and I always have talked about silver. You've been so far ahead of the curve on silver, and I think it's now being by the US now suddenly naming it as a critical mineral. To me, that would mean that they're caught in a rock and a hard place here, because that means that US mined silver, that they probably start banning the sale of it. It has to be bought internally, perhaps. I don't know. What's your thoughts? Because to me, why would you allow a critical mineral to be sold?
Right. Well, I mean, look at it this way: naming it as a strategic mineral or strategic metal automatically creates the demand of whatever the government's going to buy. And it automatically reduces the supply available to the market, because that supply is being bought up by the government. So you've already got a disastrous supply-demand equation. They just poured gasoline on that fire.
Yeah, and of course, what you essentially were saying here is that every other central bank, every other sovereign, everyone else is going to say, well, I'm not selling my silver at this price. I a much higher price, and I don't quite know what that is yet.
The much higher price, I made the comment before we started recording, be careful what you wish for.
Yes, yes.
When we go through $50, and that's if markets stay open. I mean, there could be a failure to deliver, this month. I mean, who knows? But once we get through $50, you've got people talking $100, $200, $600 silver. There's really, in today's world, there is no way to project a number that gold or silver can go to. And I mean, the reason being, the parameters are zero and infinity. And the reason infinity is a parameter is because if a currency goes to zero, then it is priced at infinity in that currency. In other words, no amount of currency can buy an ounce of gold. That currency won't be accepted. And that's where we're headed on a global basis. I mean, if you think that the US dollar can collapse, crack up, and the system remain running, that's not going to happen. It can't happen.
Could the long-awaited decoupling of paper and physical prices be triggered by a real failure to supply silver on COMEX? How long before gold officially threatens the dollar's position as the primary reserve asset if central banks continue to reduce their exposure to the dollar? If you enjoyed the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.